Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak You, a podcast available every morning on Apple, Spotify or wherever you listen. It's Thursday, the 9th of January in London. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, UK markets face ghosts of the past. Bond turmoil spreads through assets as long-simmering worries over the British economy boil over.
Wildfires tear through Los Angeles, killing at least 5 people and forcing 100,000 to flee.
Plus, is AI coming for your banking job? Exclusive research from Bloomberg Intelligence finds 200,000 finance roles could go as profits soar.
Let's start with a roundup of our top stories.
UK markets are facing further turmoil as gilt yields have hit multi-decade highs, the pound has been pummeled and equities have slumped. Concerns over stubborn inflation, a ballooning government debt pile and tepid growth have hit a nerve in recent days, with traders heaping pressure on the embattled Labour government. Here's Bloomberg's managing editor for FX and Rates, Rachel Evans.
These are issues that have been kind of lurking behind sentiment on UK assets for a while now, particularly since we had the UK budget under the new Labour Party administration back in October. People have been really growing concerned about the amount of debt that they are looking to sell in order to fund their spending plans. We've got £297 billion worth of debt to sell in this fiscal year, and those auctions are starting to come through this week as the year gets underway. So those seem to have really provided sort of a reminder to investors that this is something that they need to pay closer attention to. And I think that's really why we're sort of starting to see this more dramatic move this week.
Bloomberg's Rachel Evans was speaking after the 10-year gilt yield soared to the highest since 2008 and the 30-year yield hit its highest since 1998. The pound is weakening further today after hitting its lowest level against the dollar in 13 months. The FTSE 250 index also slumped yesterday by almost 2%.
Chancellor Rachel Reeves will prioritise spending cuts over tax hikes if rising yields eliminate her fiscal headroom. Bloomberg has learnt that the Chancellor will double down on her fiscal rules in the coming weeks, hoping to reassure investors that she would cut spending before touching taxes again. Bloomberg's James Wilcock has more.
The government will have an iron grip on the public finances. That's what a rare public statement from the Treasury said yesterday as bond yields swept higher. It's the same slogan Rachel Reeves has used for years, pitching herself as the alternative to Conservative chaos. But the Rout in gilts has brought numerous unfavourable comparisons to the Truss mini-budget saga. Now Reeves' autumn budget has left her with limited fiscal headroom and unnerved UK business. A new KPMG report shows hiring is falling at its fastest pace in 16 months as companies brace for Labour's past tax hikes to come into force. The question is what the Chancellor does next, with her own credibility at stake. In London, James Wilcock, Bloomberg Radio.
The moves in UK markets have been exacerbated by similar worries bubbling up in the US about incoming President Donald Trump's tax cut and tariff policies. The 10-year Treasury yield rose as high as 4.73% on Wednesday, pushing it toward the 5% peak hit in October 2023 before pulling back. The strains have come into focus as the US government issues a $119 billion worth of new debt this week. Speaking to CNBC, US Treasury Secretary Janet Yellen was asked for her view on the recent spike in yields.
When we see strong data on the economy, continued strong growth and strong job market, and some over the last couple of days surprises to the upside on indicators of the performance of the economy, that suggests that the path of interest rates going forward may be a little bit higher than people expected.
US Treasury Secretary Janet Yellen spoke to CNBC as the latest Fed minutes revealed that officials decided to slow the pace of policy easing in December due to elevated inflation risks, higher inflation readings and continued strength in spending. The Fed cut its benchmark lending rate by a quarter point last month, with policymakers suggesting the need for a careful approach over the coming quarters.
Now to other news. President Biden has scrapped a planned trip to Rome as Los Angeles faces its worst natural disaster in decades. Wildfires have forced more than 100,000 residents from their homes. James McDonnell is the city's chief of police.
This is a tragic time in our history here in Los Angeles, but a time where we're really tested and see who we really are. And it's critical that at these times we be patient, that we come together, that we focus on saving lives.
LA Police Chief James McDonnell there. The offshore winds that have fanned the flames with gusts of above 80 miles per hour are expected to last through Thursday, with no rain forecast over the coming days.
A new report from Bloomberg Intelligence is highlighting the potential for artificial intelligence to transform the global banking system. As many as 200,000 jobs could be at risk from AI, according to the survey of technology leaders who forecast losing 3% of their workforces on average. Bloomberg's Tiwa Adebayo has more.
Lenders could be in for a potential $180 billion profit boost thanks to AI tools, but the windfall may come at the expense of their workforces. That's according to a survey of chief information and technology officers conducted by Bloomberg Intelligence. Job cuts are expected over the next 3 to 5 years, though the scale of AI investments means overall net savings may take longer to materialise. Productivity gains are set to be the most important driver by far, with the potential to increase banking revenue by $120 to $175 billion. Banking analysts now see AI as a critical driver. The report shows mentions of the technology in earnings transcripts and presentations were more than 5 times what they were in 2020 during 2024. In London, Tiwa Adebayo, Bloomberg Radio.
And those are our top stories for you this morning. In terms of the markets, concerns growing over the UK government's fiscal trajectory saw UK assets fall yesterday. 30-year gilt yields rose by more than 10 basis points. Sterling dropped as much as 1.25%. This morning, the pound is down again, 0.3% against the US dollar. US markets managed to eke out a small gain. The S&P 500 closing higher. US cash equity markets are closed for Jimmy Carter's funeral. In terms of treasuries, they did managed to find some calm. 10-year yields closed the session unchanged. Christopher Waller, the Fed governor, saying he believes inflation will continue to cool towards the 2% target. That was one crucial bit of information for bond markets. Overnight, the Nikkei at the moment is down by 0.8%. The yen, though, seeing a pause in its slide. Those are the markets.
In a moment, we'll bring you more on the major moves in UK assets, plus details of that Bloomberg Intelligence report into how AI is putting hundreds of thousands of banking jobs at risks. But on a day when we have seen the market moves that we've seen over the past 24 hours, it's worth starting your day with the latest from Bloomberg Opinion's John Authers. In his view, the mess, his word, on UK markets is far less extreme than the Liz Truss mini-budget, but needs urgent sorting. He points to the UK's current and capital account deficit, leaving it vulnerable to foreign investors who might demand higher yields and a cheaper pound before they're prepared to buy gilts. That's looking further down the line. But he also offers us what he describes as a cacophonous soundtrack to drown out the noise of what we're seeing on markets, including Helter Skelter from the Beatles. One I was familiar with.
Yeah, that's very appropriate. It seems perhaps for the markets. So that piece from John Authers on the terminal for you to read. But we want to do a deeper dive then into what happened yesterday with the UK and where things may be going. The UK has actually been one of the hardest hit places amid a rout in global bond markets. Long simmering worries about inflation and Labour's spending plans have kicked into overdrive this week, and that is heaping pressure on the government. Joining us now to discuss is Bloomberg's Europe, FX and Rates editor, Aline Oyemada. Aline, good morning. Thanks for your time. Can you put into context the magnitude of the moves that we've seen? What has happened to UK gilt yields, stocks and the pound?
Hi, good morning. Like you said, the UK was really the underperformer yesterday. There was a global bond rout, a global market rout, but the moves in the UK were far larger than its major peers. So take gilts, for example. Yields rose more than 20 basis points this week. That compares to like 6 basis points in the US, 10 basis points in most of Europe. So you could see there was really a big underperformance. Stocks plunged the most in 2 days since August. The pound was the biggest laggard, down more than 1%, nearing the lowest in 1 year. So it all shows how this was a problem as global as the UK's.
So why has the UK been particularly hard hit, given that this was in part a global move?
Yeah, that was very interesting to see and is what is concerning. There was no domestic catalyst to the moves. But what people are saying is that in the UK, you have a very fragile inflationary and fiscal backdrop. Inflation has been sticky. This is no news, especially in the services sector. And this is a threat to the fixed income market. And then on the other side, you have a budget that for some was kind of ambitious and that counted with a very small fiscal headroom. And the higher borrowing costs means that tiny fiscal room may be even tighter when we get to the next review. And then therefore, Chancellor Reeves may have to either raise taxes, cut spending, or increase borrowing in a year when they are already issuing the second most bonds, volume of bonds on record. So this is all bad news for investors.
Yeah, indeed. And we did hear a little bit of the Treasury statement. I mean, what does this mean for the Labour government? Bloomberg reporting that Reeves is going to prioritise cutting spending rather than raising more taxes. They're under pressure.
Yes, that's correct. So they will have a tough choice ahead. It looks like for now that she will prioritize spending cuts in line with with Labour's speech of fiscal responsibility and how they've positioned since the election. We'll see how it goes. Investors are waiting. They expect some fiscal tightening and some prudence, but it all depends also on how much yields will rise further and whether spending cuts will be enough.
Elaine, what does this mean for the Bank of England? Is this something that might prompt them to react?
I think for now, the main source of impact will be on their next steps on monetary policy. If we see tax rises or more borrowing, we could see an impact on inflation, so higher inflation for longer, and this means they may not cut interest rates as aggressively as they could be initially planning. It's worth noting that the market was fairly hawkish on the BOE for a while. It expected way less interest rate cuts in the UK compared to Europe, and there was some hope that yields would be a good choice this year for investors because the BOE could cut more than people were expecting. So I think those hopes were killed for now. And what the BOE says next on monetary policy will be crucial for the market.
Yes, we'll be watching for that. Aline, thank you so much for being with us this morning. That is Bloomberg's Europe FX and Rates editor, Aline Oyemada.
Now to the new research from Bloomberg Intelligence about the impact of AI on the banking industry, finding that 200,000 jobs could be lost over the next 5 years, but profits could jump by up to 17%. Thomas Nutzel, who is Senior Banking Analyst at Bloomberg Intelligence, joins us now for more. Thomas, good morning. Good to have you with us in studio. You surveyed 92 global banks for this research. Where do they see the most immediate applications of AI?
Yes, thank you very much. So, we surveyed more than 90 banks and try to understand where they use AI most into the business areas. And definitely at the moment, it is mainly customer service, customer retention, but also very important is enhanced data analytics. And I think the most important, Rout as number one, is fraud detections and fraud detection and finding anomalies in the transactions by clients.
Okay, so detecting fraud is a key one.
Definitely.
How will it boost profits then?
Yeah, that's very interesting because we ask the banks, there's lots of noise about AI, impact on productivity, cost, savings, workforce, etc. So we ask the banks, what do you think about your cost in the next 3 to 5 years? What do you think about employment level in the next 3 to 5 years? And how do you think AI will boost your productivity, revenue generation in the next 3 to 5 years? And all in all, when you add up all this together, it's very interesting to see that the banks are very much bullish on boost productivity boost from AI. More than 80% of the respondents suggest that there will be at least 5% boost to sales revenue generation. So if we look into a 2027 estimates, it means that it can be something between 120 to 170 billions of additional revenue from successful AI application. I underline successful AI and full AI application. On the cost side, it was quite interesting to see that the management is expecting the cost to remain rather flattish in the next 3 to 5 years. And I think it is proving the fact that, it is very costly to implement AI. It's high cost, maintenance is quite high, talent is very expensive as well. You have to hire people to run AI. So in the next 3 to 5 years, I think costs may be elevated because the banks are still in the investment phase. Maybe savings will come later after all. And I think, as you mentioned, the workforce, right? Based on the results, we estimate that as much as 200,000 jobs could be lost. But you have to look into perspective of the total workforce, right? It is around 3% of the total workforce, so it's not that much, I would say. But also look at this from 2024 perspective. 10 European banks cut 25,000 jobs last year, or announced to cut 25,000 jobs. So it's not nothing unusual, I would say. It is a normal way of the banks dealing with the cost pressure, I would say.
And briefly, what sorts of roles are most likely to be affected in this job loss?
Yeah, I think all the repetitive tasks, something that can be easily replaced by robots or computers that can help your job. So something in the middle office, back office, customer service as well. Possibly you also experienced when you chat to your bank, you chat with chatbot, you chat with a robot first, and then you are put to customer service. So these roles are, I think, at most risk. But also we have to think about this from the perspective of creation of new jobs, right? Because AI is not only about replacing jobs. I believe there's also an opportunity to create new jobs, new functions like in governance, compliance, data scientists, regulatory oversight. So I think those jobs will also will emerge from AI implementation.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.